Hi, Greg. I had a couple more questions on the limited partnership, and the first thing I was one of my properties I wanted to transfer it to my kids, and I saw that in February 2021, Prop 19, I was going to have to get my property reassessed and pay additional taxes.
Your child would, okay? If you give it away,
that's
then
right,
your
yeah.
child's going to have to pay higher property
What
tax.
can I
That's
do
what
about
Prop 19 did. So what happened is back in 1983, there's this rule that came out, this Proposition 58, what it was, that attached to Prop 13, that says that because Prop 13 says if you transfer a property, the taxes are going to go up or be reassessed. But Prop 58 said, and if you make the transfer to a child or to a parent or from a grandchild to a grandparent or vice versa, if there's no parent in between, then we're not going to change your property tax. We loved it. We've been working with that since 1983. All of a sudden, the California voters in November of 2020 decided that they didn't like that anymore, I guess, and they decided to get rid of Prop 58. So now the rule is if you inherit a property or you receive a property from a child or a parent or a grandparent, then they're going to go ahead and raise your property tax. So after November of 2020, I'd say that every other phone call I was receiving in the office had to do with Prop 19. What can we do? How can we take care of it? And within 2 weeks, we'd already figured out what needed to be done. Reading the Prop 19 rule, what causes the property tax to go up is going to be the death of the owner. Okay, so what if we had an owner that never died? Now, I don't know anybody that's ever been able to do that, but I do know entities that never die. And so if you put the property into an entity and the entity is transferred to the child instead of the property, then the property owner never dies. And so that's one of the benefits we can get to help us to get our properties over to our children and have a non-taxable event at that time in many cases.
Okay. So on this new limited partnership that we'd be creating, do I need to file a tax return for it?
Definitely. This is going to be your favorite tax return in the whole world, because this is the tax return where you get to go ahead and write off all those things that will be business expenses, things that weren't business expenses before. But because now you have this business entity under the rules of the Tax Reduction Act that came about in 2017, we're able to write off more things as tax deductible for businesses. And we're going to show you how to do that. But it's going to be things that you're already spending money on. So it's not something you have to go spend more money to get a tax deduction. We're going to show you how to make what you're already spending money on. Many of the things can be tax deductible with this new business.
Okay, so if it's doing that, does the limited partnership pay its own taxes?
Well, the limited partnership, all partnerships, just like an S corporation or an LLC, they don't actually pay the taxes except for the taxes the state requires. We call them annual taxes. And so basically the taxes for on profits are paid by the owners of the FLP, and it's done through a document called a K-1. And the K-1 just basically goes out to any of the owners of the LLC that says this is our profit this year and this is your part of it and you need to pay tax on that. So you'll actually pay tax on any profits left at the end. Our goal is that as money comes in, we use it in tax deductible ways. So if it's this much when it goes in and we use it in tax deductible ways, when it gets to you, it's only this much. So we're going to be able to reduce the amount of tax that you pay. Some people say, is this going to keep it so I never have to pay tax again? No. The only way that you'll never have to pay tax again is if you give me everything you own and then I'll pay the tax on it and you don't have to worry about it anymore. So yes, you're going to pay tax. I still pay tax, but I get a refund every year, okay? And it's because I utilize a business entity to deduct the things that are legally deductible as a business.
Okay, so where does the limited partnership actually get the money to be spending on these expenses?
Okay, so that's that. There's two ways that a limited partnership can receive funds to be able to pay for the expenses that we're going to be writing off. such as travel expenses and eating out and buying equipment and things like that. And we first of all, we're going to get it from rents and income from what we have in there. So if we have our rental properties in there, the rental property rents are going to go into the limited partnership. Okay, our house. When we put our house in there, if we're going to treat it like a real renter, we're going to pay rent on it. And so that's going to have something coming in that way. If we have investment properties and investment accounts in there, then we're going to take the income that these investments make, and it goes into the limited partnership. If we have other businesses in there, business profits from those businesses can go into the limited partnership. So that's where we bring money in, hasn't been taxed yet, and then we use it up in a tax-deductible way as much as possible to reduce our taxes. The second way that we have money coming in is what's called capital contributions. And this is where we actually have money that's already been taxed, where we take some of that money and put it in the limited partnership to protect it, to make sure that nobody can touch that money. Example would be if my law office pays me something, and then I will go ahead and say, I don't really need as much money as I used to because I'm not paying my mortgage anymore. The limited partnership is. I'm not paying for most of my trips anymore because the limited partnership is. And so I take some of the money that I used to use for those things, put it in the limited partnership. It's not a taxable event. It's a capital contribution. But now we have that money to spend. So what happens is if I have $10,000 in the year come in on rents, that's income. And so I use it for all the different tax deductible expenses. And then I have $10,000 coming in as a capital contribution. So I have $20,000 altogether I can spend, but there's only income of $10,000, the part that comes from the rents. The capital contribution is not. So I actually spend $20,000 when I only earn $10,000. What does that do? On my K1 at the end of the year, I'm going to have a loss. And that loss can come right over onto my personal tax return and bring me some of those taxes that I've already paid back again.
Okay. And after setting this up, what are some of the recurring expenses that the limited partnership has?
Okay, so the limited partnership is going to, of course, need to do a tax return every year. It's going to have the $800 franchise tax for the state of California. California wants everybody who wants to be a business to pay $800 minimum in taxes, and so we do that. You're going to want to do a yearly annual meeting. Now, some people do that themselves. Most of the people have us do it because we do continued training and showing you more ways to save taxes. So, but you're going to have to do an annual meeting each year. And that's the only ones that I can think of at this time.
Okay. And does transferring any of the real property into the limited partnership actually raise my property taxes?
No, that's the beauty. There's a tax code called Taxation Revenue Code Section 62 that basically says that if you take property that's owned by certain individuals and transfer it to a business that's owned by those same individuals, it's not a taxable event. And so the property tax will remain the same. And that's what we do for you.
Okay, I see. So how about transferring investment accounts into limited partnership? Does that create any tax consequences?
No tax consequences at all. Now, if you're buying stocks and bonds with money in the limited partnership, that is not a taxable, a tax deduction. So you don't do that. There's rules that say you invest in the stock market, you're doing it with taxed money. All right, but when you receive income from that. So you go ahead and purchase $10,000 worth of stock, and it earns $1,000 for you. That $1,000 is income, and now you can use it in the limited partnership in a tax deductible way to try to make sure that's not going to be taxable in the end. But it's not taxable by transferring what you already have into the limited partnership.
Okay, I see. So things sound good. How do I actually let my CPA or my tax preparer understand what I'm doing and trying to do here?
Most people, they go through a meeting that we offer called an array meeting. And an array meeting is a 2-hour meeting we hold where we actually look at your check statements and your credit card statements and see what you're spending money on. We come up with a form that says this is who's going to pay these kind of expenses, this is who's going to earn these kind of monies, and most people take that form that we create and give it to their CPA. And by that, then they'll know exactly what we talked about on how money flows and how to do that.
Okay. So if I decide to get things going, do I get to start taking my tax benefits from the beginning of the year, or do I have to wait until later?
Depends on when you file. So basically what we've found is if you file your documents with the Secretaries of State by March 30th, they'll usually allow you to go back to January 1st as a starting date for the business, okay? If it's going to be after March 30th, you file on the 20th of April, we need to go back to the first day of that month. Now, there are some CPAs that will still take you all the way back to the first, but I found that most of them are comfortable with doing it. What I just said is that if you file in a certain month, you can go back to the first day of that month. And then if you file earlier in the year, up to March 30th, then you can go back to the 1st of January.
Okay. So on my, let's see, do I lose any step up in basis on my home and properties if they're in my limited partnership instead of my trust?
No. So let's talk about what step up in basis is. So once again, we've got it so that step up in basis says that if you own property and you pass away, they're going to act, the taxing authorities are going to act like you purchased it at current market value. So if you actually bought your house at $200,000, you kept it, and when you died it was worth $300,000, they're going to act like you bought it at $300,000. You don't have to pay the tax on that $100,000 difference. Okay, so that's what step up in basis is. So some people have said, oh, if I don't have it in my name, then I'm going to go ahead and lose that step up in basis. But I haven't had anybody in California ever have that issue. I had one person in Oregon, one CPA in Oregon that had to go research it. But in California, what happens? You put the properties in the limited partnership. When you pass away, the limited partnership has a step up in basis. So it's now valued at current value. And how does it get its value? All the owned assets have to come up in value to bring that value of the limited partnership. So we've had no issue at all at getting step up in basis on properties when they're owned in a limited partnership.
Okay, that makes sense. And is it a taxable event if I take my properties out of limited partnership or putting them in, moving them back and forth?
No, we still rely upon that 62 of the taxation code. As long as it's owned the same both ways, then we're going to be okay. So if you have to bring it out to refinance it or something, we can put it back in, and they're not going to raise your property tax either direction.
Okay, so if I want to refinance it, then I need to take it out, put it in my name first.
Only if the refinance company requires it. You know, I've had it both ways on properties I've had. Some of them will do it right in the limited partnership, and some of them need it in my name. So we just do whatever they need. And if we have to put it in our name, then there's going to be a deed bringing it out and another deed taking it back in. A lot of times the finance companies will take care of that for you. If they don't, we can go ahead and do that for you.
Okay. So can the limited partnership just buy new property directly, or do I need to do it a different way?
If you can, after a while, your limited partnership will have credit, and it will be able to buy properties. At the moment, when you first start it, it's like a teenager, it has no credit at all. And so nobody's going to give it credit to go buy a piece of property. So you're going to buy it generally in your name, and then you'd come to us and we'd go ahead and transfer it into the limited partnership after that. But after a while, once again, when it starts being able to buy it directly, or if you're buying cash, using cash to buy property, you can have it directly go into the limited partnership. Now that gives us a couple benefits that you don't get if you do it whether you buy it yourself and transfer it later. If you buy it and have it go directly into the limited partnership from the beginning, we have gotten rid of what we call a seasoning problem. Okay, and seasoning is where the courts can actually bring back properties into a person's name if they get sued, if it was done if they transferred the property within a certain amount of time. So the idea is that people will transfer property out of their name to protect it from a creditor, and so we're not going to let them do that. We're going to pull it back. And so in California, I believe seasoning is a 3-year process, okay? If you have it in the limited partnership in the first place, there's no seasoning issue because it was never in your name in the first place, so we don't have to worry about that 3-year issue. Also, if you have the property in the limited partnership from the beginning, then it's protected from creditors from the very beginning. And so you don't have to worry about what happened from the time that you had it in your name and the time that it got transferred into the limited partnership. So there are some benefits by doing it directly, but reality is that most of the time you have to buy it in your own name first and then transfer it later until the partnership has its own credit.
Okay. And just moving them in there, do the mortgage companies have any problems with me putting my properties in limited partnership? Are they going to...
We've never had any. We had one time, one mortgage company came and thought that this would be a due on sale issue because we transferred it from the people into the limited partnership. I talked to them, showed them some law, and they said, you're right. This is not a due on sale issue. Never, ever in 32 years has any other mortgage company ever come and said there's a problem. Now realize that if they did come and say, oh, we have a little issue with this, you would go back, or we would go back for you and say, you know what, by having the limited partnership, it protects the property from other creditors other than you. And so your interests are actually protected also. And so in reality, it's helping them as much as it's helping you.
Okay. Are there, so all I'm hearing a lot of really good things about limited partnership. Are there any detriments or disadvantages or cons to having a limited partnership?
Well, you have to pay the $800 franchise tax every year. That's a bummer. Okay, I understand that. I almost got rid of mine when I first started mine because I didn't want to pay the $800 until I realized that I was going to save so much more in taxes than the $800. It was worth keeping it, so I didn't. You have to do a different tax return, but in reality, that's a benefit. You'll love this tax return. You're going to look forward to it every year. Let's see what else we have. If you refinance, you need to take it out of the limited partnership sometimes and then put it back in again. So that's an issue. And so those are the only things I can think of at the moment.
Okay. And are there things you need to keep up to keep the limited partnership in compliance?
Definitely. So the California Corporations Code, which governs all entities in California, says that if you're going to have a business entity, you need to do something to show that those who are in charge and managing it are paying attention to it and doing that. So if you have a corporation, you have to have annual directors meetings and shareholders meetings. Okay, with a limited partnership, you're going to have an annual partners meeting. An LLC, you're going to have an annual LLC meeting. And so the deal is that we want to go ahead and make sure that we're complying with the California Corporations Code, because if you don't do this, your corporation becomes, or your limited partnership becomes, a de facto entity. And de facto just means it looks like a limited partnership and it smells like a limited partnership, but it sure doesn't taste like a limited partnership. It can't, and it's not good. It's going to lose all of its protective benefits by not having your annual meetings. Corporations have the same thing. You've got to do it, or they see you as an alter ego, that is just you and in an extended form, and so you don't get some of the benefits that the entity would have otherwise. So yes, you're going to want to have an annual meeting. You're going to want to pay your taxes, and you have to file your taxes. The LLC, generally under the current IRS code, says that you only have to pay tax the first year, or not pay tax, but file the tax the first year to let them know you're taxed as a partnership. And if you're taxed as a partnership and you make no money and you have no expenses, then after that you don't have to actually file a tax return anymore. So those are some things that you'll need to do.
Okay. And so is it something that I can just create myself, or it's called a partnership? Do I need a partner, or how many partners do we need?
Well, the limited partnership's going to have a general partner and a limited partnership at least, right? Most of us who have spouses are going to have two limited partners, and we generally put our partnership interest, our limited partnership interest, in our trust, and then the LLC becomes a general partner with a 1% interest. And so you can go ahead and do your own meetings. I have some clients that do their own meetings every year. Some people do their meetings, and about every 5 years they come and have us do it to kind of see if there's any changes. And then about half of them have us do it every year. So you can do your own minutes, yes.
Okay. And is it complicated to actually use limited partnership?
No. Actually, you'll find that after just a few months, it can become part of normal life. You're just going to have two checkbooks. You're going to have a personal checkbook and you're going to have a limited partnership checkbook. And so what you're going to do is every time there's an expense that comes up, you're going to say, is this a personal expense or is it a business expense? Now there's a secondary question over here. If it doesn't look like a business expense, your next question is, can I do something to make it a business expense? Okay, because this is where we want to pay for things. This is where we save money. If you're going to buy something for $10, over here you're going to have earned $15, so you're going to have $5 to pay tax and have $10 left to buy the item. Over here, all you need is the $10 because you saved the tax. Okay, on $100, you're saving $40, in tax by paying it here instead of paying it over here. And so that's the whole idea. And there's some things that are not going to be tax deductible. You can't write off going to the grocery store. You can't write off the gifts that you give to your kids at Christmas time. You don't get to. It's better to write off your donations personally than you do if it's a business. You're gonna. Your car is going to be owned by you personally instead of by the limited partnership. So there could be some personal expenses there. But the deal is we're going to try to make it so that as much as legally possible, we can write it with this checkbook instead of with that one. And every time we do it with this checkbook, it means you have more money in your pocket.
I think that answers all my questions for now. I appreciate it.
Great questions. If you have more, let me know. Give me a call at either my Sacramento office, 916-369-9750, or you can call my Lincoln office, and that's 916-645-9529. And we'd love to help you with any questions you have.